In terms of superannuation contributions, there are many types of contributions that you can make. We'll talk about the pre-tax concessional contributions and the post-tax non-concessional contributions in a little bit more detail. But there's also downsizer contributions, which allows you to put money from the sale of your house into superannuation. There's also spouse contributions, which allows you to reduce your income tax by contributing into a spouse with a low income. And if you're a small business owner, there's also various exemptions, which allows you to put money from the sale of your business into superannuation in a tax effective manner, which doesn't trigger capital gains tax. Now, pre-tax concessional contributions, these are contributions that are good when you are looking to either lower your income tax, so often for people who may be high income earners, or if you've got a significant capital gain, so you may have sold a property or an investment and it's triggered capital gains tax. For superannuation balances below 500,000, you may be able to use carry forward allowances. So what that allows is it allows you to go back the previous 5 financial years and use any unused concessional contribution cap space. You may know that the maximum that you can put in at the moment in any given year is $30,000. So let's say you only put in 15,000 for this year, you would have 15,000 allowable in your carry forward allowances to use in the next year. Now I've got a little note there saying it can be unwise to reduce your taxable income below $45,000 because at that point between 18,200 and 45,000, the tax rate's only 18%. Now, the tax rate when you contribute into superannuation in a pre-tax concessional contribution is 15%. So the differential is so small at 3% that it's not really worth it. And in fact, it would be better off in most cases to save that carry forward allowance to the next years where you can get a bigger percentage reduction. Next, post-tax non-concessional contributions. So these are often contributions you make from, say, your bank account, which in contrast to concessional contributions, they're often ones like salary sacrifice that you may have elected with your employer to take out as part of your payslip. So post-tax non-concessional contributions are good when you don't need to lower your income tax. So you may not have a high income tax due to your salary as they enter the fund tax-free, so they don't have that 15% tax when received. And they also add to the tax-free component of your superannuation balance, which is important when you eventually transfer your super to, say, your beneficiaries or adult children, if there's money left over at the end. Now, I want to take you through a carry forward contributions example. Now, this strategy can be particularly useful for those who haven't contributed for a number of years. So think about sole traders who aren't obliged to pay themselves super, or skilled migrants coming into the country who begin earning a good salary but haven't contributed in the past, and they want to make sure that they're catching up on their retirement savings, and those returning from an extended paternity leave. So let's go through the column without concessional contributions first. In this case, I've assumed this client's earning $250,000. They're making no concessional contributions, so their taxable income is $250,000. On $250,000, you would pay $87,950 in tax, which is quite significant. Now, let's say this client had funds in savings, so they could make a considerable $130,000 concessional contribution into superannuation, and that would drop their taxable income to $120,000. Then you can see the really significant effect that has on the income tax payable for that year. So it reduces by nearly $60,000 a year. Now, there is some tax that you do pay on superannuation contributions, so nearly $20,000. But the net effect when considering both those taxes is that there's a tax saving of $40,000 a year almost. And the added benefit here is we've got more money in that low tax rate environment of superannuation. So it's a really effective strategy. Now, even if you have contributed in the last few years, so you don't have the full $130,000 of concessional contribution cap space, you may have a portion. So this strategy is still very effective for most people, remembering that you wouldn't necessarily want to go below $45,000 for tax purposes. But yeah, it can be really effective for most people.